Right now, we will look at the MCQs related to the tangible non-current assets, that is IS 16 2023 related MCQs. So let's dive in. And we have the first question. What it's saying, what will be the total amount capitalized in respect of the factory? Well, we'll capitalize the land, 1200, uh, material, 2400, labor, 3000. We will architect fees 25,000, surveyor fees 15,000. Okay, 15, 25, 15. Site overheads, no, we will not consider them because these are the general costs. It will incur in either of the case. A portion admin overheads, no. Okay, site overheads will incur. Okay, a portion of overheads, admin overheads won't incur. Testing of fire alarms will incur. Business rate of fire first year will not incur because admin overheads and business rate for first year has to be incurred in either case. Either this project will happen or not. Either the new factory will be constructed or not. So now we will do the total 1200 plus 2400 plus 3000 plus 25, 15, 10. It will be 6950, and B is the answer in this case. Capita had the following bank loans outstanding during the whole of 2000 X8. Okay, 9% loan prepayable, 9 in 2000 X9, 11% loan payable, 2000 Y2, and we have to calculate the borrowing cost, which can be capitalized in respect of this project for the year end. Capita began construction of a qualifying asset on 1st April 2008. Withdrew funds of 6 million that on that day to fund construction. On 1st August, and an additional 2 million was withdrawn for the same purpose. Okay, so in this scenario, as you can see, the first time they have invested on 1st April, and the year end is on, as we already noticed, 31st December 2008. So what we will do, 9% loan into 15. What was the total loan? 15 plus 24, it's 39, right? So 15 divided by 39 into how much month? It's 9 months from April to December. What we will get? 459,000. Next, not 415. Sorry, not 459,000. It's sorry. It's 9% into 15 divided by 39 plus 11% into 24 divided by 39. So we will get 6.7%, 3.5% and 6.7%. That will be total of 10.2%. The weighted average capitalization rate. It's our weighted average capitalization rate. Weighted average capitalization rate, WACR. Okay, now the borrowing cost we have to compute. 6 million into 10.2% into 9 divided by 12. It's 459,000. Then we took additional 2 million into 10.2%, and it's from August to December. That will be our 5 months for the year. So it's 85,000, and the total is 554,000. Right, so 554 is the answer. Leckler has borrowed. Now, next question. Leckler has borrowed 2.4 million to finance the building of a factory. Construction is expected to take 2 years. The loan was drawn down and incurred on 1st January 2009, and work began on 1st March 2009. $1 million of the loan was not utilized until 1st July 2009, So Leclerc was able to invest it until needed. Leclerc is paying 8% on the loan and can invest surplus funds at 6%. We have to calculate the borrowing cost to be capitalized for the year ended 31st December 2009 in this project. So, firstly, borrowing cost from March to December, it's 2.4 million and it's on 8%. For how much months? From March to December, it's gonna be 10 months out of 12. So it's 160,000. And now we have to deduct the investment, less investment. It's 1 million investment for the on 6% rate, as we already noticed over here. Okay, 6% for 4 months, right? From April to July. Oh, sorry, from March to 30th June. It's 4 months, so 4 divided by 12. We got 20,000. We have to deduct 20,000, and we'll get how much? How much? How much? 140,000 will be the capitalized amount regarded to as. Which of the following would be recognized as an investment property under IS 40 in the consolidated financial statement of build company? Okay, build company. A property intended for sale in the ordinary course of business, that will be inventory. A property being constructed for a customer, that will come under IFRS 15 revenue recognition. So no, property held by build company as a right of asset of use asset and lease out under 6 month lease. C is the perfect answer. Because AN would be classified as inventory and WIP, the property used out to subsidiary would be regarded as an investment property in the single entity financial statements of build company, but it is treated as owner occupied in the consolidated financial statements. Remember it. Property being constructed for a customer, yes, that will be working in progress, and firstly it will be WIP and then it will be come under the IFRS 50. Now, next one. Which of the following is not true concerning the treatment of IS investment properties under IS 40? Following initial recognition, investment property can be held at either cost or fair value. That's correct one, correct treatment. If an investment property is held at fair value, this must be applied to all of the entities' investment properties. It's also correct one. Investment properties initially measured at cost, including transaction costs. It's also correct one. Next, last one. Gain or loss arising from a change in fair value of investment property should be recognized in other comprehensive income. No, that's the wrong treatment. A gain or loss arising from a change in fair value of investment property is recognized in profit or loss. The other options are all correct. Next question, and the company has the following loans in place throughout the year. Firstly, let me look at what he's asking for. The amount should be capitalized as borrowing cost at 31st December exit in respect of this asset. Company has the following loans in place throughout the year ended 31st December 2000 exit. So 10% bank loan, 8% bank loan. On 1st July, 15 million was drawn for construction of qualifying asset, which was completed during the year during 2009. So firstly, what we had 10% loan, one of 140, and total loan is 340. Plus, then second is 8% into 200 divided by 340. So we will get 4.1% and 4.7%. Overall, it's 8.8%. So 50 million for the construction of asset, 8.8%, which was taken on 1st July. So it is for 6 months only. Divided 6 divided by 12, we will get 2.2 million and 2.2 million. So the answer is D. Next question we have, whether by purchase a machine on 1st July 2007 of 500,000, it is being depreciated on straight line basis over its expected life of 10 years. Residual value is estimated at 20,000 on 1st January 2008. The following a change in legislation, whether by fitted a safety guard to the machine, the safety guard cost 25,000 and has a useful life of 5 years with no residual value. What amount will be charged for profit or loss for the year ended 31st March exit in respect of the depreciation on this machine? So firstly, they got the machine whose has a value of 500,000. What was the residual value? 20,000. What was the life? 10 years. In this year, they use it for 9 months out of 12. So we got 36,000. Then safety guard, 25,000 is alive out of 5 years. Total 5 years, they use it for 3 months in this current year. So it's 1250. Total depreciation charges 37,250. Next one, question number 24. What they're saying in question number 24, an aircraft requires a planned overhaul each year at a cost of 5,000. This is the condition of being allowed to fly. How should the cost of the overhaul be treated in the financial statement accrued for the year over the year and charged to maintenance expenses? Wrong. Provided for in advance and charged to maintenance expenses. No. Capitalized and depreciated over the period to the next overhaul. Correct. Capitalized and depreciated over the period to the next overhaul. The expenditure should be capitalized when it takes place and depreciated over the period to the next overhaul. It should not be provided for in advance because there is no obligation arising from a past event. The overhaul could be avoided by ceasing to operate the over aircraft. Okay, now next question. What will be the depreciation charge in relation to this machine in the financial statement of Auckland for the year ending 31st December 2000 X9? Auckland purchased a machine of 60,000 on 1st January 2000 X7, assigned it a useful life of 15 years. On 31st March X9, it was revalued to 64,000 with no change in useful life. So what we will do, look at it carefully. Till now, from X7 till 31st March X9, machine has been owned for 2 years and 3 months. Okay, so the remaining useful life, in this case, remaining life at 31st March X9 was 12 years and 9 months. Prior to revaluation, it was depreciated at 60,000 divided by 15. That means 4,000 per annum. Isn't it? So the charge for the first 3 months of 2000 X9 was, you can look at it, 4,000 divided by 12, 4,000 divided by 15 into 3 divided by 12. That's gonna be $1,000 for first 3 months. Right, so now machine will be depreciated over the remaining life, and what is the remaining life? We already know, 12 months or 12 years, 9 months. That's gonna be overall 153 months altogether, right? So the charge for the remaining 9 months of 2000 X9 is, so the charge for remaining 2000 x9 is x9 9 months is 64,000 divided by overall months 153, and we will get it for 9 months. This we will get how much 3765. Okay, and so the total depreciation is 1000 into 3765. We'll get 4765. Right. I hope got it. Yeah. Next question. What will be the amount shown in the revaluation surplus at 31st December 2008 in respect of this building? So Carter vacated an office building, let it out to third party on 30th June. Exit. The building had an original cost of 900,000. On 1st January 2000, X0 was being depreciated over 50 years. It was just to have a fair value on 30th June exit of 950,000 at year end of 31st December exit. The fair value of the building was estimated at 1.2 million. Carter uses a fair value model for the investment property. What amount will be shown in the revaluation surplus at 31st December exit in respect of this building? So cost on 1st January X0 900,000, depreciation to 30th June X8 900,000 into 8.5 divided by 50, we will get 153,000. We'll have 747,000. Now, asset as revalue to fair value at 30th June exit. Fair value at 30th June X8 is 950,000, and the revaluation surplus is, we will take the difference between 747,000 and 950,000. It's 203,000 will come under the revaluation surplus. So the increase of 1,200 and 950, 250,000 between 30th June exit and 30th December exit will be credited to P&L NIAS 40, right? The increase in 1,200 minus 950 arising from 30th June exit and 31st December exit is credited to P&L, profit and loss, in accordance with IAS 40. I hope we get it till here. We'll see you in the next session very soon.